All right, gents, when you're ready. Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guests today are Taylor Pearson and Jason Buck of the Mutiny Fund. It's a great name. You have to find out. You have to listen all the way to the end of the podcast to figure out why it's called Mutiny Fund, because I forgot to ask the question up front. It's long volatility and tail risk, particularly apt for this time of the market cycle. I'll be talking to them right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
How did you two guys meet?
I wrote an article and Jason read it and we started emailing.
What was the article?
It comes out of crypto, yeah.
Yeah, I was I'm trying to think when this would have been. It would have been like early 2018, I think probably 2018 at some point. I wrote an article about stable coins.
Mm-hmm.
I was interested in the idea of stable coins. And then Jason was also interested in it from the perspective of like how could you construct a basket of assets that was like stable over time. And so we started talking about that and then got into we had both read a bunch of the similar stuff around tail risk and traded options some and then sort of went from there.
So the Mutiny Fund is, from what I can see, it's a tail risk fund. Is that a fair description of it?
Yeah, we'd say tail risk and long. We always say it's a mouthful, but always long volatility and tail risk. So we have the tail risk in there. I'm sure we'll get into this, but it's built around also long volatility to maintain some of that bleed that you would get with just pure tail risk, like a Universa or something like that.
So how do you construct the long volatility component?
You use people like Chris Cole. So the way we look at it is like long volatility is a dynamic way of trading tail risk, both left and right tails. And so they're using their own algos or market timing to either structure those trades. So whether it's Logica with Wayne that's using straddles and gamma scalping the position to manage that theta bleed, but either way he's long volatility, and maybe that's the best describer for long volatility is your long volatility on both the left and the right tails.
Right.
And that's probably the simplest way. And so we use firms like Logica that straddles, and then firms like Artemis that strangles, and we also use some opportunistic traders like Headwaters Volatility. But like that combination gives a kind of the long volatility profile. We add back in those like kind of deterministic rolling puts that would be typical tail risk, and then around the periphery we use like volatility arbitrage and intraday futures traders to kind of manage that bleed or give some uncorrelated rebalancing premium that we can try to maintain that profile during a risk on cycle.
So what's the objective with the fund? Is it to provide blow up protection, or is it to you can allocate however much of your portfolio to it, and then it's both it's going to manage through the good times and through the bad?
Yeah, the idea being that spoonful of sugar. So for decades, Taleb and Spitznagel and all these guys have been saying, you should just eat the bleed of tail risk. And we just felt behaviorally people aren't willing to do that. So we believe in ensemble approaches. So we think through the ensemble approach, we can try to maintain a flat or slightly positive return during a risk on cycle that will make sure people hold it on their books.
Yeah. So
that way so it's really just that spoonful of sugar to help the medicine go down to make sure you maintain that tail risk protection for the blow ups. We want to try to use an ensemble rebalancing premium approach to try to maintain a flat to slightly positive carry instead of that negative carry, and then your CalPERS and you get rid of it right before the blow up.
they always seem to. It's funny, isn't it? Like there's the two challenges that I can see with tail risk is the bleed over a long period of time makes it hard for folks to hold, and then on top of that, really what they should be doing as the short volatility side of their book, however that's constructed, as that's going up, they really should be rebalancing away from that and increasing their allocation to long volatility. But that's hard because they're looking at that side losing all the time. And it's a sickening thought, particularly when we've been through these very long periods of volatility suppression. Then the other challenge is when you finally get the blow up, it needs to go the other way. You need to be able to rebalance away from that side of the book that's working so that you can now go and buy all of these undervalued assets on the other side. It's just hard in a lot of funds to achieve that because the lockup and so on.
Yeah, I think
Go ahead, Taylor. Sorry.
No, to going back to the goals thing at some point, like I think the way we generally talk about it is like the goal is to like help investors maximize their long-term compounded wealth. Like that's the goal. And from our perspective, the reason we started this was like this was we felt like an essential piece of being able to do that, and just like was really hard for non-institutional investors to get access to these sorts of strategies. So yeah, I think you're right. Right, you want the end investor to look at the whole portfolio, right? It's like this is improving the long-term compounded growth of your portfolio, and we've had to be conscious to some extent of like people are going to look at it as a line item, whether or not they should, and they probably should to some extent, but like by having it, by sort of trying to bundle it up and like look at this in the context of the broader portfolio. It's a little more palatable.
Chris has got the great analogy of Dennis Rodman, the worm with the rebounding, saying, if you've got a really good offensive team and you got one guy like the worm getting the ball back and feeding it back to the guys who are offensively strong, and that's so the worm's your volatility, your long vol portion, and the rest of the team is your short vol portion. And so he goes and gets the rebound, feeds it back to the offensive team, and all of a sudden you're much more powerful than you'd be by yourself.
Exactly. And we're Taylor and I are big fans of like deep value. We think this actually pairs phenomenally well with like deep value. And because like you alluded to, it's like when that sharp sell-off happens, a liquidity event crashes, and we provide like almost like a convex cash position. Now you have tons of cash sitting on your books, so you rebalance into value at even better prices. So like it pairs incredibly well over market cycles with deep value. And the way we look at it too is we don't believe you should try to time that insurance. But by having managers that are trying to time that insurance, but an ensemble of them, it allows you to just hold that on your books, which allows you to take more risk of that implicit short volatility. So you can hold more deep value if you have like us sitting on the books, and you can sleep at night.
Yeah, you're gonna get those. Like just using something as simple as the CNN Fear and Greed Index. I don't know if anybody else tracks that. I don't know how intelligent that's regarded in the vol community, but it's just something for non-vol guys like me. I just got to look at it. When I look at the performance of that thing, I go back, you get about 2 bites of the cherry every single year where you get CNN Fear and Greed goes, below 20, which is very much the fear side, below the fear side. That's sort of, if you've got a long vol component, like you're getting 2 opportunities a year to take away from the long vol component, to jam it a little bit longer so you get that third pocket opening up with a little bit of extra cash in it. I think that should be a very successful strategy.
Yeah. If we just can convince more people of it, that's all we're trying to do.
It's always going to be hard when it's a market like this, right? Where it's just, why would you hedge anything? Like the best performing asset in the world is the S&P 500. Why hedge anything? It's just going to keep on going up in a 45-degree line, right?
Well, and this market's really interesting too, because it's like it's going up in a 45-degree line, but 6 months ago it went down at an 88-degree line, right?
that was just a blip.
Yeah, right. But I think everyone's like on both sides of it. It's like, yeah, it's going straight up, but like it just went straight down. How is this going to play out?
The market just completely forgot that happened. I think it's as if like you could just rub that off the chart, and it just keeps on going straight through it as if it didn't happen.
Yeah. And to your point, that's when that rebalancing is phenomenal. Like at the end of the March, we would allegedly been up like 10% after fee. Like then you could have rebalanced back into all of your stock positions and then just crushed like since then.
Right. So how did you? So you wrote the article on Bitcoin. It's or stable coins. How do you get from stable coins to volatility?
I think at least philosophically for me, like, I don't know, crypto, I think you could think about like Bitcoin, if you want to take Bitcoin specifically, like it is a long volatility thing, right? Like the only way in which Bitcoin could possibly make sense as an investment is like if stuff gets weird, right? Like if the stock market just keeps going up 20% a month, inflation stays at 2%, nothing happens. Like it in my mind, it's a long volatility bet. So like, again, going like, as Jason said, like we're sort of big believers in this like ensemble approach in general, and like in particular ensemble approach to long volatilities. Mutiny Fund is a portion of that. Could look at commodity trend or gold or Bitcoin as just, other aspects of like expressing that sort of long volatility piece of the portfolio.
So has Bitcoin behaved like long volatility?
No, I wouldn't say it has. I would say it has. I think it has the potential to do so in the future.
If you get some sort of if you get inflation or hyperinflation, that's the kind of scenario where it works well.
Yeah, exactly. I think it's regarded as highly speculative, and I think like that's the appropriate thing, and like you should, people should position size it as though that's the case. But yeah, I think it has interesting theoretical properties to me that it could behave it's similar to a gold or in an inflationary environment.
What are the theoretical properties?
So like you look at like what is it that makes gold particularly, why is gold considered a good, I wouldn't say it's a good inflationary hedge, but hyperinflationary hedge. The primary thing is like the stock to flow ratio, that it is, the 100 years of history, like in no year have you been able to mine, I can't tell you the number off the top of my head, it's like 2.5%. The total gold stock has never increased by like 2.5%. And that's just like a function of geologically how gold is in the Earth's crust and like how expensive it is to mine it. And all those sorts of things. And so like Bitcoin has the same property, but it's not a function of geology. It's a function of the way in which the consensus mechanism is established and new Bitcoins are created. That's programmatically determined. The whole sort of like proof of work mining algorithm is basically a way that makes it prohibitively difficult to change that, or at least uneconomical to change that. Like I think that's part of the interesting about Bitcoin is like it's more profitable to play by the rules than cheat the rules, right? Like, you can, there's a sort of like, there's all these like game theory scenarios, like under what scenario is it profitable to undercut Bitcoin? And it's just like, it's hard to find those scenarios, right? Like you need the Chinese government decides it's not in their national security interest, then you have like a huge externality. But if you just look at it as sort of a microcosm, the security model is very interesting, and the stock to flow model is very interesting. And then I think it has some properties that gold lacks. One, the stock to flow ratio is theoretically more predictable. It is more predictable. Like we can say with a high degree of certainty, how many Bitcoins are going to be created over the next 12 months. Whereas like gold, you put it within a band, but there's some variance there. It's obviously like easier to transport, right? Like I need a USB stick, or I need 24 words in my head, and so you get people that make the like, if you were a Jew living in Germany in the 1930s, like it would have been useful to have a thing where you could remember 24 words, and like that would be your wealth, and you could get out of town. So I think there's like interesting theoretical properties there. And then I think like another element of it that like we really are just starting to see is sort of this like programmability element, right? There's this whole sort of one of the recent trends this year has been like decentralized finance or DeFi, and that you can do all these, you can program money now, right? That's sort of the interesting thing. And to some extent, you can already do that, right? Like some people can go to JP Morgan and like write these big complex contracts for certain derivatives or whatever, but like what happens when that's sort of more broadly available? Probably what happens initially is like what's happening now is a mix of like a lot of fraud and people doing gambling and like a bunch of stupid stuff. But in the long run, it seems very interesting to me.
Can I ask you a noob question? I understand the scarcity argument when it comes to Bitcoin, but isn't that sort of thwarted a little bit by the fact that it's so easy to create a competing currency?
Yeah, there's a guy named John Pfeffer. I think he was he's like at a big PE firm. He wrote an interesting paper. This was like 2016, 2017. And I haven't really read anyone that's written sort of like a good rebuttal to it. I think it's like an institutional investor's take on crypto assets. But like basically the thrust of his thesis is, let's just say there's like, two cryptocurrencies. Like you're always going to hold the one where everything else being equal, you're going to hold the one that is like more secure and like a better supply schedule, right? And so like the only way in which, for example, you have a new cryptocurrency that like supplants Bitcoin as just like a store of wealth is you have to, basically like convince the market that that's going to be a better store of wealth in some capacity. I just think that's very hard. I think like with the security stuff, especially with like Bitcoin, the way the mining industry is structured, there's just like a lot of, like it's totally doable in the same way like you could start another search engine that, is better than Google, but it's just like there's a lot of network effects.
Okay.
To make that hard. Yeah, I'm not explaining that super well, but
no, I understand. But there are some competing, like Ethereum's. Another noob question, but Ethereum supposedly got some properties that are makes it more useful than Bitcoin.
Yeah. But they're totally different. Yeah.
Yeah, I think that's like we'll see how that sort of shapes out. But like I think Ethereum only works. So like this was the paper I mentioned. Like this was specifically one of the things he talked about is like, let's just say it's just Bitcoin and Ethereum, and like the bet Ethereum is making is Ethereum also wants to be a form of money, but it thinks, if we have all these applications which have all this utility because it's easier to program on Ethereum than it is on Bitcoin. I'd say sort of at a high level, the way I think about the trade-off at least is like Bitcoin is sort of more secure but less adaptable or less flexible. I mean, the programming language Ethereum uses is Turing complete, which gives a lot more flexibility but also increases the attack surface, whereas Bitcoin uses a much lower level programming language, which makes it more secure, but also makes it like much harder to write applications in Bitcoin. So, some applications that you can write in Ethereum, you can't write in Bitcoin at all, and others might take, 50 times longer to write just because of the level of the programming language. But, let's just say you have those two things. And so like effectively like Ethereum then is like your working capital, right? I'm going to use this thing, to execute these smart contracts that are going to be able to do all, whatever these different forms of programmable money thing, yield farming, all this stuff. But if it has a higher inflationary schedule, you're not going to store. You're going to minimize the amount of working capital you can hold in that thing, and then you get into the the velocity problem. Like money only has value if people want to hold it. Like as soon as you have something with a very high velocity of money, like the value goes down. So like the whatever crypto wins is it has to minimize that velocity in some capacity, and so like Bitcoin seems much more focused on that than Ethereum.
I'm gonna flub the name of the law, but isn't that the good money drives out bad? Isn't that the way that theory? Gresham's law, yeah. I think it's called like the theory of exchange. It's been a while since I've read up on this stuff. But like MV equals PQ is what it is, and I'm not going to remember what all the variables mean. But it's like the quantity of the money times the price of the money is equal to the velocity times and I'm like forgetting what M is. But basically the way it nets out is if the velocity is high, the price is low. And if the velocity is low, the price is high, sort of all other things being equal. And so like the challenge, I think, with a lot of these, like Ethereum in particular, but these sort of like more smart contract, we're going to be utility, is they have like, it could be Ethereum is wildly successful in terms of people build applications on it, it becomes highly utilized, but also like accrues no value, right? Because like the logical thing to do is to store all your keep as much of your money as possible in the thing that is more likely to retain value, and then just use whatever the minimal amount of working capital you need is in the thing to Ethereum or whatever the smart contracting token is to execute the things. And then you get into like security issues, right? Like if it doesn't have value and like the mining or the consensus mechanism is like based on it having value, does it become less secure? And you get into some sort of death spiral, and what does that look like? To what extent does having a macro view, or to what extent do you guys have macro views that you sort of employ in the management of the fund?
We don't. So the way we look at it is like you don't want to time your insurance. So that's why we tried to build the product the way we did, that you can just hold it indefinitely. And we actually come from kind of the background of, Chris Cole's Dragon portfolio comes out of the intellectual pathwork of Harry Brown's permanent portfolio, which then Ray Dalio piggybacked on for risk parity, which then like Chris Cole's Dragon portfolio is like a modern interpretation of that. But the way we try to look at it generally is that nobody can predict the future. If they can, none of us would be talking to them. They'd own New Zealand at this point. so it's it's an entertaining game to predict globally macro, picture and what's coming in the future. And I think all of us get caught up, our egos get caught up in that game. But we try to build a portfolio of this ensemble approach to long volatility and tail risk, so that way you can hold it indefinitely, and it makes you sleep at night while holding these implicit short volatility, long GDP assets. So we try not to predict futures at all, and then we rebalance frequently to also harvest a little bit of rebalancing premium off of the dispersion of our managers' returns.
Yeah, that's refreshing to hear. It's as much as I like following macro the way I like following sport, but I wouldn't ever use any of it in anything that I do.
Yeah, you would, and I feel the same way. It's entertainment, right? I love watching the entertainment, and then but the hardest part is you can't let your ego get caught up in it, because it's so sexy for your ego. You're like, ooh, I agree with my green hero. I disagree. I agree with you. Like, you just get into these loops, and you're like, I can predict the future. I'm all knowing. I'm omnipotent, right? It's so sexy to get caught up in. But like, I was watching Dan McMurtry was on Real Vision yesterday, and then I was just looking through all the comments, and I was so confused. Because everybody's like, I disagree. He's an idiot. He doesn't know this, this, and this. And I'm like, instead of typing that up, there's a market where you can go and take the other side of this trade. Like, why are we pontificating? Like, this is show me your book, put your money where your mouth is. There's no reason to talk about any of this. And then what I always find fascinating about global macro that drives me nuts is, like, you can have guys that completely disagree with each other. So let's just say, like, Mike Green and Ben Malcolm completely disagree. But the way they construct their portfolios is what matters. But everybody's worried about this narrative. But it's like, as long as they construct their portfolios with a ton of asymmetric bets, they can both be right and wrong on simultaneous things and still end up out ahead on their P&L. And nobody sees that. Like, everybody gets caught up in these beautiful narratives. And I understand it's a beautiful framework they build, but like, literally nobody can predict the future. So it's perverse.
I couldn't agree more. That's almost always my first question when someone has one of these very elegant theories. Like, how do you execute it? Like, what are you going to do?
Yeah.
What's the construction?
Exactly. Tell me your position sizing. Tell me your other positions. Show me the asymmetry of the trade. Then that's all that matters. And it was interesting. I tried to do that with like Hugh Hendry, because like in the past he talked about being a centipede. If he's got 100 positions on, he doesn't mind chopping off a few arms. Right. And so that's what matters, not what he thinks about, are we going to negative rates or not? Like, it doesn't matter. It's about show me your book of construction of the trades.
I find Hugh in particular. I love Hugh. I'm not trying to be critical of Hugh, but when he lays out his theory, it seems to me that it's got this is going to happen, and this is going to be the impact of this, and then this is going to happen. And by the time you're at like the third or fourth derivative, I'm like, well, what's your confidence around each of those? Like, what's the probability that each of those occurs? And then, multiply any probability, any set of probabilities, even reasonably high probabilities, in a sequence. And that the chance that they all happen in series or in sequence, you get a very low number at the end.
Right. Exactly. And that's why you need to construct these hugely asymmetric trades. And so you only need a few of them to hit out of, 30. That's because you're adding, like you just alluded to, you're adding such a specific path dependency. But they do that also to get such cheap convexity. So it's this trade-off between nailing the path dependency versus the convexity of the position. So if it was a very vanilla trade, you might only get 3 to 5 to 1 payout. But if it's crazy path dependency, you might get 20 to 51 payout. So then you're trying to layer in like path dependencies, hoping you hit a few of them.
It's the parlay bet. It's heading to the racetrack and trying to get a number in a row.
Man, you have. I swear you're inside my computer, Toby, because I just interviewed Diego Perea, and that's what I talked about. I used the analogy of parlay bets, and as all of us know with a parlay, you get one of them, 2 of them right, you're like, oh shit, then the third one,
I'm retired.
You're back to 0 every time. And so that's essentially, if you have exotic correlation trades, that's exactly what you're doing. It's a parlay bet. And we know, and like, so yeah, if you've been a sports bettor, you understand the excitement, but you also understand the probabilities are incredibly low.
Yeah, you bought a lottery ticket. It's fun, but it's going to pay off like a lottery. So I read in your bio, Jason, that you come from a property development, real estate. Is that so? How do you get from real estate in 2008 to volatility in 2020?
Sure. So they bookend each other incredibly well. So basically, from my side, this has been a 12-year project to bring Mutiny Fund to fruition. So in 2008, I was a commercial real estate developer. I owned several restaurants as a part of a restaurant group. I even owned a wireless internet service provider. So I owned all these businesses, but primarily commercial real estate development. And when you have that liquidity dry up, like we saw in 07, 08, 09, and see how that just cascades through the entire system, that pain was so profound for me that I figured there had to be a solution. So as entrepreneurs, we're just, Taylor and I are just problem solvers. So I was like, there's got to be a way to hedge some of this liquidity, this macro liquidity risk, right? Because as an entrepreneur, idiosyncratically, I can really believe in myself and I can really work hard on my projects. But if the global macro liquidity drives up, I'm screwed along with everybody else. And then especially if you're looking at from the commercial real estate development space, is you have to predict like 5 years out, right? If you start a project, and you have to hope that everything ceteris paribus is going to be low vol from now to those 5 years path dependency for you to pay out your pro forma idea of what this project is going to pay out. And so if you have to take such long time horizons, there's got to be a way to hedge your macro risk. And so for the last 2 decades, I've been trading my own book ever since I was, even a teenager, but really got into trading options and trading the VIX around 2010, 2011, and really was working through a lot of these ideas. And so through losing money doing these trades is how the best tuition in the world, right? That pain makes you dive more into it and learn more and more and more. It's why I don't get upset about Robinhood like these other old guys do. It's like you forget when you were young, we were all doing really stupid things. We lost money, and that was the pain and the tuition that made us learn more, right? So it's no big deal. And then so throughout that process of trading options and VIX and everything, I started tracking a lot of the other managers in the space, reading Chris Cole's work, et cetera. And just over time, just felt there's so many path dependencies to risk off that you need to cover a lot of path dependencies for it to work. And this is where Taylor and I really came together was, we were looking at placing our own money with like, say, an individual manager, but there's a lot of idiosyncratic risk there. So we both believe in taking this ensemble approach to really reduce that idiosyncratic risk and cover as many path dependencies as possible, knowing none of us know a priori, once again, what the future is going to look like. And so to do that, we figured this was a multi-year project to work with the lawyers and everything and to figure out all the workarounds and everything to actually offer a product that retail, our family and friends could use, but also we could use. And so part of that, to get to that ensemble approach, is you had to be able to aggregate a bunch of retail investors to a QEP minimum fund. And that's how we could actually place our own money with this ensemble of managers. So we actually, built it for ourselves and our family, knowing that it'd also be helpful for other people.
Yeah, I've because I met Chris in about 2010. That was sort of the beginning of my education in volatility started around about then. Took about 2 years, about a bottle of wine a night for about 2 years with Chris explaining it over and over and over to me until I did finally get it in about 2012, and then hasn't really worked that well since 2012, although it did work earlier this year. So how did you guys fare through the big drawdown?
So I'll maybe let Taylor talk about the timing of when we launched our fund.
Yeah, so we went live in April, like mid-April. So we started, I guess as I'm sure you're aware, we thought we started sort of working on it in earnest beginning of 2019. We're like, oh, we'll just get the lawyers drop the docs and raise the money and it'll be no problem. And it took basically a year. I think we finally got all the docs and legal stuff done just before the holidays of 2019. So we started basically fundraising mid-February. And so March was, it's just very interesting conversations, right? It's literally we're on the call with someone and the market's down 4% since we started the call. And
compelling pitch.
Kind of so yeah, so we either got really lucky with the timing, it was obviously it was on everyone's mind, or really unlucky with the timing. So ideally, February 15th would have been a nice time to have launched.
I think Chris got a little bit lucky with his timing. I think he might have launched either January or February 2012, and there was a big vol spike, and then not much in the intervening period from sort of that time until this year.
Yeah,
and
that's
big drawdown.
Exactly. I think you're exactly correct on that. And part of it is, this is why we use that ensemble approach, is you can get pops in volatility in different parts of the space, whether it's in VIX, futures, or in options. And so we try to use those ensemble of managers to capture some of those pops and then redistribute it across the portfolio to help the P&L while we're waiting for that big risk off event. So that's another way to try to cover How do you carry this position during a risk-on environment? And then, as you know too, what's nice too is as we get closer and closer to that risk-off event, those options and volatility become suppressed, and those options become cheaper. So you're actually loading up on inventory serendipitously right before the crash happens.
It's one of the nicest things about it. You sort of you're sizing into it right at the right time.
Except for the flip side of that, though, is that can go on for years. Right?
Yeah, well,
you're like, this is great, my position, so it should be coming, and then it's 17, 18, 19, you're like 20, you're like, when is this going to happen?
That's I read Taleb's more readable book, not Black Swan, before the one that Fooled by Randomness. Thank you. Yeah,
I agree that it's his most readable book. That's the one.
I couldn't get through the other ones. I'm sorry.
I think that one was successful, and so then he could just tell the editors to fuck off and do whatever he wanted. Like, I think Fooled by Randomness, he wasn't that big, and so like he had to do what the editors told him to do. So that got streamlined. But then after that, he was like, yeah. Yeah,
I'm the bloke who sold 3 million books, so I'm gonna give you the manuscript, and you're gonna publish it.
Exactly.
Yeah, that first book was spectacular, and I when I talked to Chris, I was like, oh, here we go. This is how you actually implement this strategy, and this makes total sense to me. Like everybody underweights the tails because they happen so infrequently. Everybody's clustered around the mean. Buy the tail, sell the mean. This game is really easy. And then the thing that Gladwell points out. Gladwell wrote an article about him. I think it's called The Blow Up Artist or something like that. And he said the only thing basically that can happen to you is you can just bleed out. And I was like, yeah, but these things happen so frequently. The 1,000-year storm rolls around every 7 years. You're not going to bleed out.
Yeah.
Of course, here we go into one of the longest periods of volatility suppression. You see it, like I see it happen to value guys wind up their funds. Like it's one of those things that, I find value so compelling from a theoretical, logical standpoint. How could you ever not do value? And then you realize that there are these very, very long periods of time where it doesn't work. And the reason that value starts working again is all the other value funds just get wound up. They just disappear.
Exactly. Yeah. You know that pain of looking back over long time periods. But part of it though, where we take a bit of umbrage with that people don't consistently look at is the holistic effects of your portfolio. And I think Mark Spitznagel at Universa, which is, Taleb's partner, Mark actually runs Universa, is that the way he explains it so well is it's a combination, right? So if you use Universal, let's say it's a negative 3% bleed, just to throw out some numbers, but they're allowing you then to carry 97% exposure to the S&P, and let's say they're truncating your left tail at negative 15 to negative 20% moves, and you're blocked off from that down. And so the combination of that rebalancing over multiple business cycles, actually you end up ahead. So it's a weird thing. It's more about actually being able to hold more implicit short volatility assets, long GDP assets, and comfortably hold those in rebalance and compound wealth better over time. But everybody only looks at that line item. So a lot of the arguments this year from like AQR, et cetera, we're just talking about the line item and not talking about the holistic portfolio construction and what that allows you to do to compound your personal wealth and savings over time. And so, like, for example, I think that Universa's, likely cherry picking the timeframes as we all do, but like that combination compounded at like 11%, where like a 60-40 was compounding at like 6 to 7% over the similar timeframes.
Yeah, there was a great article just after Spitznagel had the big win where it was like goat farmer makes 4,500%, something like that.
On Forbes.
Yeah. Forbes.
It's a classic Forbes headline.
Yeah, that was weeks of me in Twitter DMs and everything breaking down what that actually means. Yeah, it's incredibly frustrating to have to deal with sensational journalism.
Well, I think Chris was in the same boat. He's got all of these people who've invested with him saying, well, why didn't I go with this other bloke who's returned 4,500%? And he's just a goat farmer. Like, here are you. You're doing this stuff all the time. It's like, well, it's calculated the way that they do.
Well, there's two pieces of that, and I'll break it down quickly. One, by the way, his goat cheese is incredible. I grew up in Michigan, and he has this beautiful farm in northern Michigan, but he smartly bought that farm after 08-09. He made such great returns in 08-09. He invested in a goat cheese farm. It's actually arguably the best goat cheese in America. So I'll set that aside. It's amazing.
My wife will be excited to hear that. I think goat cheese tastes like it comes from a male goat, but my wife loves it. So we have it in the house.
It actually makes me think of that. There's I don't know how true it is, but there's a thesis that if you have goats that eat poison ivy, that gives you immunity to poison ivy by drinking their milk or eating their cheese. Yeah.
I smell a DTC brand. Someone's going to search that. There's a supplement company in there for sure.
But then the 4,000% return, the easiest way to break it down, I'll just say it simply, that allocation to Universa was up, let's say 12.8% total in March of this year, and the S&P was down 12.4%. So net, you were up 40 basis points. You're up 0.4%. So they did their job. They covered that tail risk. They covered the downside risk. Fantastic. Good on them. But it's not a 4,000% return. Let's just be clear about that. Once again, looking at the holistic portfolio construction.
But it does make some sense if you can think about if they can truncate the left tail so that you draw down, say, half as much as the market. You're already 100% ahead when the market recovers. So then if you're giving away a little bit every year, a few percent, that's quite a few years before that unhedged portfolio catches up with you. And then, likely you get another big drawdown somewhere through that. And that's all you have to do. You just have to keep on sort of staying. As long as you're not drawing down as much, it does create, it's a much more attractive return profile anyway. Yeah,
it's a more attractive return profile, but I also want to highlight again that with that profile, you're able to hold 97% S&P exposure, where in 60-40 you only have 60%. So you're actually also outpacing when you're waiting for it to happen, minus your bleed. So it's that trade-off of 97% exposure minus a small bleed. How does that compare to 60-40 during risk on? And then obviously the compounding is just exceptional when you have these risk off events, when you're able to rebalance into that lower NAV point.
When you have an environment like this, which is an unusual one, so in the late 1990s, in the dot-com boom, there was this, and Chris alerted me to this a little while ago, and I've always wondered if we'd see it again, where you had this, where the market's going up and you have upside volatility. So the volatility is going up as the market's going up, and ordinarily it's the other way around. As the market goes down, volatility goes up. As the market goes up, volatility goes down. And here we are in this environment again, likely driven by maybe Robinhood option positions, or how do you guys fare in a market like this? And what are the causes? Why are we in this unusual environment?
All right, so there's multiple ways to look at this. So the way to look at volatility in general is people in risk-on times, unfortunately, to start to see S&P and VIX as negatively correlated, right? Because they are. Because the way VIX is not only downside volatility on S&P, it's just outsized volatility. And unfortunately, the truism of the market takes the stairs up and the elevator down is why we usually see that negative correlation and see VIX up when S&P is down, because of the violence of those moves are outsized of what the standard deviation is expecting that return to be. But if you have a melt up scenario and the S&P or individual stocks are ripping up to the upside, but those returns are outside of that standard deviation for that day of what VIX is expecting, you're going to have VIX up, S&P up. So these things happen. Like you're saying, 99 is a great example. Abenomics in Japan is another great example. But they happen infrequently, but they do happen. And so you have to be aware of those different times when you have VIX up and then spot up, which S&P up. But also part of that too is you have to always worry about the term structure of the VIX trade, so it's not always so simple. But going back to what you said about the environment we're in right now is you have not only retail traders, Robinhooders buying options, and how much that affects the the dealer gamma hedging or of those positions, is you always can have these wonky environments for volatility and equities. There's no free lunch, right? If VIX and S&P were perfectly negatively correlated all the time, it'd be such an easy trade and we'd all make money, right? It's these times when you have these 3 to 6 week periods where VIX and S&P are kind of all over the place. They're getting a little wonky as you've been in the markets long enough. There's a lot of things we can't explain that we just call wonkiness. It's like saying there's dark matter in space. It's just a fancy way of saying I don't know, right? So this is what happens. So what you have in hindsight is everybody's going, it's the Robinhood traders, it's the SoftBank's long gamma position. They're long Vega positions, but those are farther out. But they're also hedged for equity. So everybody in hindsight is trying to be a detective and get their Sherlock Holmes hat on. But even they can't all correlate around an actual explanation. So like you were talking about earlier, it's not even so hard to predict the future. In hindsight, it's hard to predict the straw that broke the camel's back, right? But part of it is it's just that S&P and VIX can get wonky, especially when you have an environment where VIX tends to have a bimodal distribution. What that means is simply during a risk-on cycle when volatility is suppressed, you have low VIX, and the average VIX tends to be 12. Okay. Then you have a risk-off event, a violent phase shift happen, and VIX has a separate distribution based on a higher volatility environment where it averages around 20 to 22. So you have these two different environments. And when you're in that higher vol environment with a higher average vol, you can have more of this wonkiness between VIX and S&P. So you can actually have days when VIX is coming down and S&P is also drifting down, but the drift down in S&P is less than the average estimated standard deviation move of that single day. So that's how you can have these environments when you're coming from, high vol and it's drifting back down, where you have volatility down and S&P down in the same day, because they're small drift moves that aren't spiking volatility back up. Now, eventually it'll drift back down, where then any move in S&P will spike volatility because it's a mathematical relationship. But this is what we see over the last few weeks, and then everybody tries to decipher what, why, where, when, how, when is, like I said, dark matter or wonkiness. Yeah.
I guess the challenge for implementing one of these sort of strategies is you can't trade the VIX directly. You're trading options or futures on the VIX, and so there's lots of smart guys. You've got Ben Eifert out there. You've got Chris Cole. You've got Himmelstein. You've got all of these guys out there who are, there are expectations built into the pricing that you're getting at any point in the VIX. So, in an environment like this, is this a good environment for vol guys? Is this a tough environment for vol guys? Am I asking you a question like, is this a good market for equities? Is this a bad market for equities?
Exactly. It's kind of
the answer depends.
It depends, but I'll kind of break down the buckets or how we view it, and that might be helpful. If you're talking about somebody that was just purely buying options, right? As VIX is coming down, you're still paying up for that implied volatility, so you don't quite have the convexity when you're buying both puts and calls, and so it makes it a little bit more difficult environment for buying options, right? Because you don't have that. So you could still be directionally right, but if implied volatility came down, you lost on the Vega side of that trade, and you're combining that with the theta bleed. So this is what the Robinhood traders are going to learn a lot, is like you can be directionally right, but it's about the price you paid for that option and the path dependency it took to get there. And so you can be directionally right and lose money trading options. So that makes it difficult for options traders in general. I'm not going to speak for actually any of our individual managers. They know this, right? They've been in the game for decades, so they try to maneuver around this. The other way, the bucket we look at it with futures, is we have managers that can trade intraday futures, and they can go short those markets. So now they're not paying for that implied volatility. They're not worried about that implied volatility at all. Then it's just about continuation of the trend intraday in market indices around the world. So this could be potentially a target-rich environment, or you never know a priori. It's just like all trend following, right? You put on the trade, you hope for the best, you have a short type top loss, you get whipsawed a lot, but eventually you make a bunch of money. So that's the way to look at the futures bucket. The Vix arbitrage bucket, though, is I don't want to speak to what Ben Eifert does, but the Vix arbitrage is like a relative value trade. So it's relative value either on Vix versus S&P, which is the intermarket spread, or on a calendar spread on Vix. So those give you more of a mean reverting pairs trade. So any environment can be good depending on your positioning and your ratioing of those, Vix to S&P positions or the Vix calendar positions. It's like how many units are you short versus how many units are you long, depending on what the market's giving you in the Vix that specific day or week. So it's hard to say a priori if those are good or bad environments for the VIX ARB. It depends on where their algorithms are positioning them, if that makes sense.
So the vol surface, the VIX term structure is a little bit like each month going out from here until the election, say, we know that there's an expectation of there's always shenanigans around the election. There's going to be we don't know what's going to happen. There might be some volatility, and so the market is expecting volatility. So that I'm not sure if it's the October or the November, but there's a definite hump around there, and there has been for a little while, which means that traders expect there to be some vol around the election, and so there may be an arbitrage there where you may be short that volatility and long some of the more front month stuff. So if you get a volatility event before then, you catch the front month volatility, and maybe you're paying for it by being short that November volatility. Maybe it's going to be a non-event. I'm not necessarily suggesting that anybody put that trade on, by the way. I'm just using that as an example.
Well, I'll counterpoint you, and that will hopefully keep somebody from putting that trade on. So as you know, there's never any free trades, right? And so part of that hump in the VIX term structure is because VIX is a variance swap on 30-day forward variance. So that's why that October contract, even though it expires in October, is looking out into the November election. But then you look at the November election and you're in backwardation. So what that says is, like, if you're a long front month, you have that the term structure roll yield is going to kill you being long front month. And then if you went short back month, the backwardation is going to kill you. So they're not giving you, what I'm saying is the term structure is screwing you to like make sure there's no easy trades, because there's no easy trades. So that's the way to look at it. The other way we think about it sometimes internally is that I used to trade option straddles going into earnings on like tech companies, and trade the IV ramp going in pre-earnings and then close out before the earnings. And what you would find a lot of times is, if the last earnings announcement was pretty benign, it would be very low vol heading into this one. If the last earnings announcement beat expectations either way, all of a sudden you'd have high vol going into this one. So it was a form of recency bias. And so if we think about the last election, most people didn't predict the volatility of the last election. And so now all these smart traders are so doom and gloom and predicting, oh, Trump's not going to accept the election or Biden won't accept it. It's because they got caught with their pants down on the last one, and they have recency bias, and these things only happen once every 4 years. We have so few data points. At least that's what internally I can't help but seeing that connection or correlation with. And I'm not saying this one's not going to be contentious or any of those things, but this is why going into the last election, you would have had the vol term surface would have been much lower, and this one's much higher. And to me, it's more of a recency bias.
I think there was a hump going into the last one. I think I remember Chris pointing it out to me, which is why I might have been looking for it this time around. But what does that mean? It might have been. There was a lot of suppressed volatility around anyway, so I think it was. It might have been a much lower market. When you look at the going into the earnings, if it's high vol, are you just trying to find a way to short the vol? If it's the other way, if there's low vol, you're trying to get long the vol. Like how are you thinking about that as a trade?
So previously when I say this, and by the way, it's a great trade. It's just a highly capacity constrained trade. So somebody can make a decent living trading this. But the idea is generally that anywhere from 30 down to 7 down to 3 days prior to an earnings announcement, what's going to happen is more traders start to want to trade around earnings. They're going to get more into the markets, and then the dealers are going to raise that implied volatility of that position. So what you're hoping for, this is why I say you're riding the IV ramp. If you put on a straddle where you don't care if it's going to be up or down, you're playing your implied volatility and then the gamma of that position as we get closer to the announcement. But what you're looking for is basically the implied volatility to rise faster than the theta bleed on being long options. And then you want to actually, the way this trade works is you close prior to the earnings announcement. So a lot of times they're after hours. So you'd close that position the day up. Like, so for example, what's interesting is, and I haven't seen great data on this, it's hard to get it, but like if you opened a straddle trade and that morning, the IV ramp till the close that day is going to rise enough to offset the theta for that bleed. If it doesn't, you're going to lose a little bit, but you're still long a straddle. So let's also say during that 7 days prior to that, also an exogenous event happens like 9/11, you're long a straddle. So it's actually kind of a great trade, but you're in it maybe one week a quarter. But that's the idea behind it, is it's just the pricing of that IV ramp. You're hoping it's going to expand, and that expansion of IV is going to offset the theta bleed, and so that way you can pick up a few pennies here and there every earnings cycle.
So you're not implementing these strategies yourselves, right? You're doing this through managers. So Mutiny Fund is a fund of funds. Is that a fair description? Yeah,
I think that's accurate.
So how are you? I mean, how do you validate the managers? How do you make sure that the portfolio, as you think about it, is properly diversified across strategies? What's the process there?
So we think about it in multiple ways. So the way we wanted to build this portfolio, because like we said, it was Taylor and I scratching our own itch, and so it was our own money going into this. So we had to figure out what we wanted, and part of that is the path dependencies. But at the end of the day, we wanted to have a portfolio that was buying as many options as possible. As Nancy Davis calls it, it's debit card investing. You know what your downside risk is. You don't have a blow-up risk. You can bleed to death from 1,000 paper cuts, but you know exactly what's there. You don't know what your upside potential is with buying options, and that's difficult for most people. But we structured the portfolio primarily just around buying options because we knew exactly what that P&L would look like. Now, part of that, what we referenced earlier, is you can have bleed in a risk-on cycle. You don't know how much or where it's necessarily going to come from, but you want to kind of limit that bleed as much as possible. And we use very active managers, whether it's Logica or Artemis or Headwaters, that are trying to almost like time that market position or load up or delever on inventory or gamma scalp if it's Logica. But basically, if we can create an ensemble of active managers in the buying options positions, we look for primarily moneyness. So when we're looking across those, we look at like Logica's at the money straddles. So that covers kind of the at the money position, and they're gonna, primarily they're gonna do great maybe on a -5 to -20% move, because they also have to pay for the offsetting position premia. So you're not going to get it right at the money, but it starts to cover, those smaller or closer to the money moves. We start to get out of the money. We're looking at like an Artemis strangle that's out of the money. You're going to get more, explosivity, but you have to have that path dependencies needs to tick down far enough for that to really kick in. Headwaters does, Matt Rao does much more opportunistic trading kind of around positions where he's looking for cheap convexity. But we're trying to primarily create the options bucket around the moneyness of the managers. So that's how we look at those manager positions and position sizing, is the probability of that path dependency combined with the moneyness of that path dependency. And then we try to overlay those or overlap those so we capture as much of the meat of the move as possible during a risk off.
Yeah, that makes total... Sorry. I was just going to say that makes total sense.
Okay, well, good. That sounds good then.
So a smaller move is going to be Logica. A bigger move is going to be Coal. They're less likely to happen, so Coal's going to be sized slightly smaller than Logica. And then you've got the bread and butter day-to-day is Headwaters. Is that fair?
Yeah, and another way to look at it, and then we also look at adding managers that may take some basis risk after a sell-off, like Diego Perea at Quadriga, that's maybe trading correlations trades or FX. Like we look at those too, and we track those, and we may be adding those, in the near future. But the other way to look at it too is if you're Chris Cole Artemis and you're maybe in the market only 40-70% of the time trying to limit that bleed, Taylor and I worry about what happens if you have an exogenous event on a Saturday or Sunday and our managers aren't fully positioned. Logica will still be in there, but they may have a little less inventory of puts than they normally have. But we really worry about that sleep at night of our portfolio. So we added back in those deterministic rolling puts, and we use Hari Krishnan to manage those. And so that way, if there was some sort of exogenous event when markets aren't open, we always have those puts on. And so part of always having those puts on, that's why I say deterministic, because we know exactly what the bleed is going to be from those puts. But we view, through taking this ensemble approach to long volatility and tail risk, we can cover that bleed. So we're happy to have it and be safe at night. So the way we look at covering the bleed of buying options is we added these periphery buckets with VIX arbitrage and short-term futures. And by having these three different market structures of VIX, options, and futures, and then an ensemble of managers inside of each of those buckets, there's a lot of like dispersion to their returns that we can harvest a rebalancing premium between them. And we try to use that overarching ensemble or mosaic approach to try to have a flat to slightly positive carry over an entire risk on cycle while we're waiting for that risk off event to happen, but we're sitting on a massive inventory of options when that risk off happens. So we have that huge convexity to the down move.
I think at a high level, the way we typically talk about it is like carry certainty and convexity, right? Like that's the trade-off space that we're dealing with. The ideal sort of long volatility, tail risk hedge, you want to have high certainty, you're capturing it. You want to have, flat to slightly positive carry would be ideal. And you want to have like a lot of convexity in the case of that risk off event. And so like as Jason was saying, that ensemble approach, helps us on all of those layers, right? You have the individual managers that are trying to trade off that carry convexity, right? If you're just rolling puts, you're going to have that convexity, but it's going to really hurt your carry. And so having lots of different managers that are doing some form of market timing and then combining them all together, right? We get the same benefits of that carry convexity that they're doing, but then also adding that certainty back in, partially through just having the rolling puts, but then, by having, 9 different managers, if 2 miss it and 7 get, like that's fine. We're able to sort of increase our certainty there.
Yeah, that makes an abundance of sense to me. If folks want to get in touch with you or follow along with what you're doing, how do they go about doing that?
So mutinyfund.com is the website. We have a newsletter that we send out a couple times a month just with updates. And then Twitter is probably the best place. Jason and I are both active. So Jason is his handle's Jason Mutiny, and mine is Taylor Pearson, ME. So that's probably the best way.
And I should have asked earlier, but why Mutiny Fund? Why Mutiny? It's a great name. I love it.
Why Mutiny? I guess
I was going to say, there's, as you know, Toby, there's part of the function is every name's taken.
Yeah.
Right. So as you know, like you try to come up with a business name, you're like, this is a great one. And then you Google search it and like everything's taken. But it was a combination of factors. One, we had all these highfalutin names like ataraxia, which was, Greek for like unperturbed by external events. And luckily, Taylor's wife and my girlfriend were like, no.
Too hard. Yeah.
Yeah, exactly. All that stuff. So always had this idea of mutiny kind of in the back of our heads because from multiple perspectives, it comes actually, one of them's from Hugh Hendry. It was always talking about Crispin Odie of like the 70s and 80s swashbuckling CTAs that were running like 40 vol. And it's like, where have all those pirates gone? So we were thinking about that in the back of our minds. But also there was a mutiny club in the 70s and 80s in Miami, in Coconut Grove. And it was like this meeting place for eccentrics. So you would have spies from Europe, South American industrialists, and then like the whole like cocaine cowboys trade. But it was not only, it was a nightclub and a hotel, and it was like every room was different. It was just this amazing place. And so, outside the drug part is like, we look at it as like a meeting of the minds of eccentrics and trying to, bring together all these different worlds. And then we just, love the idea of, from a marketing perspective, what Mutiny gives us. And we know we're different. We're outsiders anyway. So instead of pretending like we're not outsiders, we just kind of play into it, I guess, a little more than other people would.
Yeah, that's great. I'm really envious. That's a great name. Thanks very much, gents. That's all I have time for.
Cheers, Toby.